Well, it's the number one question for investors, particularly real estate investors. I mean, for us, I'm totally fixated on rates and what they're implying in the shape of the yield curve. Because if it was a normal recovery, you would have expected a more normal, less flat yield curve. And so I think there's two reasons why rates could rise. The first was a happy situation, which was the economy was getting better. Wages were picking up because we have low unemployment. Rates that rise because of a healthy economy are probably okay. They're good for stocks and they're probably good for real estate. Because at the end of the day, investors care more about rent growth in property than they do about minor shifts in interest rates. And 50 basis points, 3.5, isn't going to impact your long-term projections. Especially since in this environment, actually spreads are coming down.
Sure.
So if I borrowed at 200 over whatever LIBOR was or the Treasury, I'm borrowing at 150 now. So it's about half of the increase in rates has been absorbed by spreads compression. But on the other hand, if rates go up because of political noise, because there's a buyer strike, too much supply of bonds in the market, not enough buyers, I think what the government did was very risky, and I think it's being reflected across the entire investment spectrum.
What the government did in terms of cutting
coupling
taxes
a $1.3 trillion tax cut and then a $300 billion spending bill, I would say was fiscally irresponsible. So and I think that is spooking people, that rates could run away. And we would have, we spent last year about $263 billion on interest expense. On 15 trillion, that's like, what, 2% or something like that. If rates go to 4, that'd be $600 billion of interest expense. It'd eat up $300 billion of discretionary spending. And you could come up with a scenario, and it's not zero, that we could wind up having to print money to pay interest, print money to pay interest.
So based on this
larger
thesis
deficits
of yours, what are you doing about it?
Personally, I'm short rates, like everyone else in America. And I'm actually short against my exposure in our real estate assets because it's the one thing I really can't control is a meltdown in the bond market. We're being more defensive and looking at more secure income streams in properties. And then picking, we've shifted probably our attention overall offshore. We've been much more active in Europe than we are here.
Austria,
Germany, Austria, the Nordics, Sweden.
Barry, can I go back to your comment regarding it being fiscally risky to do a tax cut? We were mired in a sub 3% GDP growth for a decade under the previous administration. And I'm not defending the political aspect of it, but there is now discussion to be well north of 3% over the next 2 or 3 years.
We're waiting for it.
Okay, but if that's the case, and there's two reasons I think the tax cut was imperative. A, we were not competitive with European rates at all, and lots of capital was moving and inversions were occurring. But if we get to 3.2, 3.3, 3.4% GDP growth, you've paid for 60%.
I don't think he had as big of a problem with the tax cut.
I don't have a problem with the tax cut
combined.
But look, you have to take the tax cut, and then somebody's going to have to get to entitlement reform. Right.
Well, those are two different issues.
Yeah, but they're both.
But they're hand in hand.
They're hand in hand on deficits. We were going to go to $1 trillion again on deficits without the tax cut, just on entitlement spending. And I know that.
Were you fine with the tax cut before you saw the new budget that came out?
I was surprised at the scale of the tax cut. It was bet the ranch. I mean, we have to grow. If we grow, we pay for.
Not personally. Most of these people here are paying more tax. It's just corporate.
We don't pay more tax,
I am personally.
Yeah, you. Oh, yeah.
Yeah, it's
because
a salt
you're in
state.
New York.
In New York, New Jersey, Connecticut, and any of the salt states,
By the way,
you're going to pay more.
You haven't felt the full impact of that yet.
No, but I've had people run the numbers. I'm going to pay significantly more.
39 to 37 is not a tax cut. I wanted to get down to 28, so we're not finished cutting taxes. But the corporate move was interesting. That was interesting. That makes it competitive.
Well, and what Congress has said is that they had to change the individual situation with taxes so that you could pay for the.
You go from 37 to 28, and I assume you're going. If you think what already happened is fiscally irresponsible, would you be, beating the drum harder or no?
No, not until we see what happens. And it also goes to immigration. I mean, we need labor.
Right.
So if we're going to grow this economy, we need those 0.5 points of growth that we get from immigration. So, I mean, you look at the economy right now, and I think you'd have to say, don't you think it's a little weaker than you would have thought?
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.